Hello and welcome to Scope's Portfolio Manager Conference. My name is Barbara Klaus and I will be your host today. Today's theme is concentrated equity portfolios, so high conviction portfolios which each contain 20 to 30 stocks only. And we are talking about philosophy behind it and their particularities, and also why these approaches can be successful also in a post-COVID world. Therefore, we have two managers here from AllianceBernstein, Jim Tierney and Michael Phelps, who are both running concentrated equity portfolios. Jim for US and Mark for global equities, and they will share their insights with us. Both follow the same investment style, but with different regional focus. And so the managers today will tell us how they find the best ideas, how they control risk in their portfolios, and we will also speak on the impact of COVID, their ESG approach, and their outlook. But before we start, some technical details. I would like to remind you as participants that you have the possibility to ask questions either in English or in German by using the chat window on the right side. You will also have the possibility to download the presentation, which is above our window, a little button, looks like a cloud. So there you can download the presentation during the webinar. So then let's begin. Hi, Jim and Mark. It's great to have you here today for our webinar.
Nice to see you, Barbara.
Thanks for having us.
Thank you. So I would suggest that we start with your philosophy. So we are speaking about a concentrated equity approach. You're looking for 20 to 30 most attractive stocks within your global or US universe. What is, in your view, the advantage of such a concentrated approach? So Mark, could you tell us a little bit about your philosophy?
Yes, of course. And as you can see on the first slide, it is a very, very straightforward philosophy. So this statement almost seems a little bit old-fashioned. We believe that long-term consistent earnings growth drives long-term investment returns. And it sounds a little dry, but if you think about what that really means, what we're looking for are companies that can grow their profitability year in and year out. We're not looking for blue sky, supernormal growth. We just want well-established businesses with strong earnings and profits that are going to be able to do it consistently over time. And the reason that matters so much is that there aren't many companies that can do that. But if you can find them, they're very valuable. So when the first question I get asked is, Mark, why do you run a concentrated portfolio? And we've had the US portfolio for over 45 years and the global portfolio for over 15 years. The first reason is if you want companies that can grow consistently, there aren't very many. So don't invest in things that you don't believe in, invest in things that you do believe in. So if you look at the characteristics of the US portfolio, Barbara, can you move that forward? Well, thank you. You can see here that it's had 15 to 20 stocks over the last 45 years. We have a very strong active share. What that means is we are not trying to replicate the benchmark. We are trying to beat the benchmark consistently over time. This is not about index hugging. And so what matters there is where you can see the upside, downside capture. In other words, anything above 100 on upside is we're beating the market, and anything below 100 in down markets is we're also beating the market, and that matters a great deal. We also have low turnover. We try to find companies that will grow consistently, and if we do what we expect, then over time, they can be in the portfolio for many years. So a company like MasterCard, for example, has been in the portfolio since its IPO in 2006. We do mid and large cap stocks. We're not doing small cap stocks. We just like companies that are already established and moving into that hockey stick of growth where they're really starting to drive underlying returns through both top line growth and margin improvement because they've already made the expenditure on CapEx. We have a minimum position size of 2% in the portfolio. The maximum is 10. We're usually somewhere between 7 and 10 on the US portfolio and somewhere between 5 and 7 on the global portfolio, which has 30 stocks. So those are the characteristics, and you can see returns have been good. And we are a growth manager, unambiguously, but we are not a blue sky unicorn manager. We're not buying companies with revenue growth but no profits. We like profitable growth. This is similar for the global portfolio. You can see here 30 to 35 stocks. Again, very high active share. Again, very good upside, downside capture and low turnover. So the characteristics of both of our concentrated strategies are very similar. So going back to the proof statement regarding how many companies are able to grow consistently over time, this is a chart that goes back over 30 years, and it's looking at, of the world's largest 1,000 companies, how many have been able to grow their profits by more than 10% per annum. And that's not a real stretch. The underlying average over this period is about 6 to 6.5%. So we are looking for companies that are better than average, but not dramatically so. But what we want is to have those companies that can do it over many years. So you can see on the left-hand side, of the 1,000 companies, about 370 have managed to grow their earnings by 10% per annum for 1 year. But if you do it for 3 years, it drops down to 63 companies. And if you do it for 5 years, it drops down to 12 companies. So there really aren't very many. This is not particularly surprising, particularly over 5 years. You normally have a recession of some sort. So what this is telling you is those companies, those 12 businesses, have their own drivers of growth, not just from the macro perspective. Why does this matter? Well, as you can see in the orange dots, if you can find these businesses, they're very valuable. So the 373 add about 1% to performance. The 63 add 2.3% to performance over the benchmark per annum. And if you can find the 12, they add 3.3% per annum. And that's the type of number that we're looking to achieve for our clients. And we have done that over the long term for both the global and the US portfolio in excess of 3% per annum returns over the benchmark, which we're very, very happy with. So the question I tend to get asked straight after that, can you move me to one on, Barbara?
I got it.
Thank you. Well, are you any good at finding the 12 companies? And this is quite a complicated chart, but the principle behind it is very simple. The lime green bars are the underlying earnings growth in the portfolio, the global portfolio, since I started it in 2005. And what I want that lime green number to be is ideally above 10% per annum every year. The blue bars are the performance. And as we know, particularly looking at 2008, when there is a financial crisis and stock markets fall, everything goes down together. But as you can see, the earnings, in other words, the profits in 2008 didn't. They still went up 5.7. So what I want to do is control for E, the green bars, knowing that if I get the earnings right, the blue bars will follow. But I absolutely also know in the short run, you will get blown off course by something like a financial crisis or COVID. So if you look at the very right-hand side of this chart, you can see the earnings in aggregate in a COVID year, a pandemic year, were flat. We had some companies continue to grow nicely, some that didn't do very much, and one or two that were down significantly because their businesses were closed. But net, we still kept profitability around the same level. And of course, because the markets recovered positively because of government actions to deal with the COVID situation, the markets actually did quite well. But for me, what matters here is I am controlling for E earnings, knowing that it will drive P performance. And you can see that in the box at the top. We have consistently had significantly better earnings than the market, and that's led to consistently better returns than the market. And if we do that over time, our clients will be very happy. So that's it from me on the philosophy to start with.
And let me jump in here and just amplify one point that Mark said, because I think understanding our performance pattern, both in the US and the global portfolios, is very important. And we measure that via up capture and down capture. And you look at the US statistics, 105 up capture, 92 down capture. You look at the global statistics of 109 up capture, 89 down capture. that's a very different performance pattern than many growth managers. There are a lot of growth managers that are 120 up and 120 down and just hoping that you have more up years than down years. We're trying to get it both ways. We're not trying to hit the ball out of the park by any means, but we're trying to more than participate in good markets. But the hallmark of what we do with these quality companies that we own is providing downside capture. In those tough years, we're protecting your client's capital, your capital, much better than the average manager. And that's a very important dynamic, because when you don't dig as deep of a hole, there's a lot less to dig out of to get back to whole. And that's an important thing to understand. And I think the question becomes, well, how do we do that? And this really gets into the overview of our investment process. And I could use the 1,500 companies in the US or the 25 or 3,500 companies around the world that Mark looks at, but we start with that as our universe and say, where can we find quality companies? And to us, we're looking for market caps of $3 billion or higher, because we are mid and large cap managers. We're looking for companies that can grow their earnings over the next 5 years by 10% or more. They don't have to have done it over the last 5 necessarily, but they definitely have to do it over the next 5. And I think that's an important point. And then we're excluding low quality companies. So a low ROE company, a very high capital intensity, a commoditized business. We want nothing to do with them, because those are just not good investments over time. They have their point in time, and every now and then they can be successful, but over time, they're just not the kind of companies we want to invest in. In the US, that gets us down to about 50 to 100 companies that we're looking at. And globally, that's around 200 companies that Mark and his team are looking at. From there, we go out and we kick the tires and we do the due diligence there. And we're trying to find and answer a very basic question, which is, do we want to be in this business with these people? If the answer to both parts of that is not yes, we're just not going to invest. And we don't have to. We don't have to buy the market. We don't have to buy what's in the index. We just need to find 15 to 20 great companies in the US and 30 to 35 great companies in the global portfolio. So it's a very select process. In that process, we're incorporating ESG, which I'll talk about in a couple of minutes. Very importantly, we have a different sort of funnel as we process ideas. And that funnel starts with an idea, and it could come from Mark, it could come from me, it could come bottoms up from the analyst team. And once we get that idea, the analyst by sector goes out and does, call it 2 or 3 weeks of work on the idea. They then come back to the team and say, hey, here's an idea. Here's what I've learned so far. What do you think? It's nowhere near a completely finished or researched idea. It's just, would this pass muster? Maybe. And the whole idea there is to have bad ideas washed out very quickly, where the team says, that's just never going to pass. We don't like it for X, Y, or Z reasons. So that's an important aspect. But the other aspect of it is the team then bombards the analyst with questions. What about this? And what about this competitor? And what about this changing industry dynamic? And the analyst is not supposed to know the answers to any of those up front, but that becomes the marching orders. That becomes what they start researching as they're doing their work over the next 2, 3, 4 months. Very important dynamic. So the analyst then goes back and does another 2, 3 months of work, and then comes back to the team and says, hey, I'm really excited about this. I think this idea can work. It's now time to meet the management team. And that's an important dynamic from a team process. It's not just the analyst, or not just the analyst and me, or the analyst and Mark going out and seeing the management team. It's the bulk of the team. And that's an important dynamic, something that most teams don't do. In most scenarios, it's just one analyst that has all the information, and the team really doesn't know much about the company. But our team-based, our collaborative process allows that. And our concentrated portfolios also allow that. So in the US, as an example, of the 6 people on my team, 3, 4, 5 people will go out and visit the company in their place of business. Again, incredibly important to understand the culture of the company that you're investing in. And the only way to do that is by seeing them in their place of business. Once we've done that, we literally have a thumbs up or thumbs down vote in terms of, yes, this should go on our approved list, the 40 to 50 names in the US, or the 80 to 100 names on the global universe, or you know what, after all that work, it still doesn't pass muster, and let's just look for something else. From that list, we're then creating our valuation metrics in terms of forecasting out 5 years, and essentially saying, what is this business worth in 2027? We then discount that back to today, taking into account risk factors. And then we create portfolios. And again, about 20 stocks in the US and 30 to 35 globally. But very importantly, and this really touches on risk, is we're looking for 20 different ideas in the US. Mark is looking for 30 to 35 different ideas globally. And I think the common perception of most people around concentrated portfolios is it has to be riskier. And I completely and wholeheartedly disagree, and our standard deviation metrics would prove out that our portfolios are not riskier than the competition, the broader base 80 stock, 100 stock portfolios. And that's because we're owning quality businesses run by quality management teams, and we have different ideas. If I love MasterCard, as Mark mentioned, which we do, we're not going to own MasterCard and Visa and Square and PayPal and American Express because we become the payment processing or the card network portfolio. We have one great idea and then 18 other uncorrelated ideas or 19 other uncorrelated ideas in the US portfolio. So I think that's really important. And let me stop there with process. Always happy to go back and take questions after that.
So thank you very much, Jim, for walking us through the process. It is really relieving to see that the risk profile we spoke about, the downside capture of the portfolio, was better than for the peer group average or an index. So it has fallen less. But one thing about these really concentrated portfolios, and you have said that your position size is usually at a minimum 2% and can go up to 7 to 10% maximum, which is sizable. So idiosyncratic risk is really high in these approaches. So how do you avoid picking the wrong stocks and destroying maybe a year's outperformance?
Sure, very fair question, and one we frequently get. And I think that it really starts again with quality businesses. And when you own good businesses, they tend not to blow up. And that's important. And good management teams figure it out. And as we saw through the pandemic over the last 15 months or so, good management teams figure out how to cut costs as necessary. They figure out how to adapt their business. And as Mark said, the biggest risk in any portfolio is not hitting your earnings projections. When you're only looking at 20 companies in the US and I have 6 people, that means each analyst is covering about 3 names in the portfolio. Mark's 33 stocks across the 11 or 12 analysts. That represents, again, about 3 names per analyst in the portfolio. When you have that kind of focus, that tends to mitigate the risk. And so the common perception is you own more stocks, it's less riskier, and each one doesn't matter as much. I'd actually turn that upside down and say, when you own that many, your winners don't matter that much. And quite frankly, when we look at the big contributors to our portfolio, it is the 6, 7, 8% positions in the US that drive performance each year. And we know those companies inside and out.
Just to finish off on that, Barbara, if you look back at this chart, you can see that the earnings last year in a COVID pandemic were basically flat for the portfolio. So the profits didn't go up or didn't go down. For the index, profits went down about 20%. And that's what we're trying to do. So when we talk about risk, we are talking much more about absolute risk, continuing to see our companies grow, hold their profitability. What we don't worry about is our risk relative to the benchmark. Investors, I think, get much too fixated about what the benchmark is doing and want to move in line with the benchmark. If the benchmark's going down, we'd much prefer not to go down with it. And that's what high active share is about. It's about being differentiated to the benchmark because we think our businesses will hold up their earnings much better in down markets. And that, as Jim has already pointed out, is what gives us good performance in down years. And that matters to clients a great deal.
Okay, thank you very much, Mark, for that. Before we move on to our next topic, I would like you to tell us a little bit about yourself and your team. So how long have you been with your team at AllianceBernstein? How is the team structured and how do you collaborate with each other?
Certainly, let me jump in and then I'll pass it to Mark. I've been with this strategy for 21 years as of next month. I've been in the business since the late 80s, starting my career at JP Morgan Investment Management. I just think this is a better way to invest. We're not trying to mimic an index. We're really investing, and that tends to drive better results over the long term. In terms of my team, I'm very proud of the team. While I have more gray hair than anybody, at the same time, the average experience of the entire global team, as well as the US team, is north of 21 years in the business. And importantly, each of my analysts have largely been covering their particular sector their entire careers. So Mike Walker is a technology specialist, and Anna Tosic is a consumer discretionary specialist. And I think that brings an extra level of knowledge and relationships and understanding of an industry that strategies where they bounce around from sector to sector to sector to learn the entire market, those kind of strategies fall short in our view.
So from my perspective, I've been doing this now for over 30 years. And my background was in the army and then coming into the investment business, having studied economics. Similar to Jim, I've always just liked to understand a lot about a few businesses, really get to know them well, really dig into those businesses. And what we've got here is a team, as you can see, of 14 professionals around the world who are working closely together at identifying really interesting ideas and then challenging each other on those ideas. So an idea, as Jim's already mentioned, can come from anywhere. Within the US, we tend to have sector specialists, as Jim mentioned. Within Asia, you can see I have two in Hong Kong, Selena Lin and Jeff Lau. I have one in Singapore, which is Sui Santan, and I have one in Tokyo, which is Izayami Takanaga. In those parts of Asia, it's still very important to have the regional understanding. The cultural nuances in China, Hong Kong, Japan, Singapore are very different. You need to understand them. And if you don't have that linguistic understanding, it's very hard to pick them up. So I started going to China in the late 80s. If I go and see a management there, the investor relations person will translate and he will tell me what he thinks I want to hear. If I have my own team with me, they'll translate what is actually being said. And it makes a real difference to how we go about investing. It really helps get conviction. The other thing that matters with this team is we can interact. So for example, one of the US analysts may be looking at one of their companies and the growth is coming from China. It's a US company though. Having someone on the ground who can go and kick the tires. So for example, year before last, Starbucks Capital Markets Day was in Shanghai. Jeff went to Shanghai to go to that meeting for the US analyst. A lot of those meetings are in English, but a lot of the conversations that happen outside of the meetings are all in Mandarin. And Jeff can give great feedback as to what is going on and what he's hearing. And so having those two things work together is very valuable. The other way around is Izayami Takanaga was looking at a healthcare company in Japan. He's not a healthcare specialist. And this Japanese company's growth is coming out of an opportunity to sell more product in the US. So he was introduced by David, who's a healthcare specialist, to go and see a number of doctors we work with regularly to understand why they like this product, what they had to do to convince them, what the competition was like, where the pricing environment was. We really use these teams very interactively. So even though Jim's team is looking at the US product and mine are global, the reality is there's a lot of feedback between the different groups to get to the better understanding of every company's underlying growth and profitability.
And I think, Barbara, one of the other things you asked about is collaboration. Certainly, we're doing a lot of collaboration within the team, but then we also have multiple other teams at AllianceBernstein that are doing similar but not exactly the same thing. And we are able to collaborate with them with a major base in London where Mark is and a major second base in New York where I am.
Okay, then thank you very much, Jim and Mark, for your insights. I think the key points from my point of view, from my analyst point of view, is the long-term experience of the team, then the on-the-ground coverage with diverse backgrounds regarding sectors or countries the analysts sit and come from, languages, which is really a success factor, and also the concentration. When you have a concentrated portfolio, each analyst can focus on a handful of stocks, and of course the robustness in the business models. So thank you for walking us through your process and team. And the next theme I would like to touch on is a very important theme that has gained even more importance over the last years, and also in this theme, ESG investing, it might be of importance to know the company very well. So therefore, before we would touch on our next topics, I would like to speak about ESG and what your approach is and what you focus on. and if you also engage with the companies you invest in. So, Jim, could you please tell me a little bit about the ESG approach?
Absolutely. We are big believers in ESG. When we look at ESG, though, everybody does it differently. Here's how we think about it. The way you drive alpha with ESG is by owning the improvers. You can passively sit by and hope that the company improves, or latch on to a company that is improving, or you can proactively encourage or push or force that improvement. The latter way to do it is how we think about it. Certainly, when you look at the slide that we have up, we're looking at MSCI scores, we're looking at engagement, we're using third-party resources. We have some will not do's, whether it's controversial weapons or tobacco, coal mining, and so forth. But I'd say that's the minor part of how we think about ESG. Instead, we're looking at ESG for research purposes, which is this the quality of company that we think? And then what kind of impact that can we have? And when you look at both our strategies where we're owning hundreds of millions of dollars of stock in each company that we own, when we hold them for 3 to 5 years on average, and sometimes more than 10 years, when we have career analysts that have been following these companies, we have what I call a great seat at the table. Companies want to engage with us as opposed to an activist that is going to buy the stock. As soon as they do something, they're going to sell the stock and they're going to be gone later. So that seat at the table is very, very useful within ESG. And from that perspective, you look at the US, last year alone across our 20 stock portfolio, we had 60 engagements touching on 89 different topics. You look at the global portfolio last year, we had 110 engagements overall, touching on 181 different topics. And last year, our 2 hot buttons, which I think it's important to focus on something as opposed to being completely scattershot. Last year was all about the carbon footprint of every company. Wherever they were, we wanted them to get better. If they were not reporting anything, we wanted them to start reporting. If they were reporting, we wanted them to have a reduction goal. If they had a reduction goal, we wanted them to then go, when can they get to carbon neutral or carbon zero? And that was a huge focus. And then gender diversity across the employee staff and boards was incredibly important. This year, we're keeping with the carbon neutrality or push and the carbon footprint. We're also getting into ethnic diversity within companies and on boards, and we're looking at modern slavery just to make sure, we don't think it's anywhere, but we're doing a deep dive to make sure that it's not in any of the supply chains of the companies that we're invested in. And quite frankly, we published about 2 months ago our first annual stewardship report. And for those that are interested, we're more than happy to get you a copy. It's about a 25 page document that details everything that we do. And it actually has real life examples of who we engaged with, when, and what the outcome was. So I think we're not just talking the talk, but we're walking the walk on ESG.
Okay, thank you for your overview, Jim. What question that bothers me is if there are any regional differences, if companies, on how willing they are to engage with you, and maybe also how strong they place the emphasis on ESG investing. What have you experienced?
So why don't I start with that? Because I'm spending a lot of time talking to different businesses in different parts of the world. I think we all know that ESG in the European context, particularly in the sort of Northern European area, has been a big factor for quite some time. And as a result, I think everyone is very familiar with the language and very familiar with what is expected of them. That's not to say we're perfect by any means. We've got a long way to go. But the discussion and the debate has been part of the investment process for some time. Within the US, that's very much moved up the agenda over the last couple of years. And now I would say is of equal magnitude in terms of how people are thinking about it. And particularly, and this is the key thing, as we've seen over the last couple of years, companies that are better scoring on the ESG front have been performing better. And as funds start to flow to that area, that helps performance. As performance get better, other investors who might not have thought it was important see it's important from a performance perspective, and it begins to build itself. So I think that becomes slightly self-sustaining. In Asia, it's slightly different. It is less well articulated and less well understood, and companies in many respects are moving towards it, but they are now getting the message quite quickly. If you look from a top-down perspective in China, the administration is making it very clear they expect huge strides, particularly on the environment, over the next few years, and Chinese companies are getting it. In Japan, it's funny, we've talked to a lot of Japanese companies, and they score on some ratings agencies quite poorly, but the reason for that is they don't give any data. And the reason for that is they've never really been asked for it very much. So we've been to a number of Japanese companies and said, look, your ESG score is terrible. Why are you not doing this? And they say, oh, we do this. We do this report. And we say, well, publish it, and suddenly your ESG score will get better. So there were very different dynamics between Japan, for example, and China. But in all areas of the marketplace, you are having a much better dialogue. People are expecting that they're going to have to report on this. And it goes back then to Jim's point. All of our discussions with companies around the world is not to say you have to be perfect today. What we want is to start a dialogue. What we need from you is transparency, and that's critical. And we still have some issues in Asia, I think certainly more than Europe, on transparency, but certainly getting better. And the reason that matters is once it's transparent, you can work out where the company is today, and from there you can measure improvement. And that's where Jim was talking about impact. How do you get impact? And it will only happen if you can see the data transparently and then measure it over time. And as soon as a company does that, you're moving in direction. And now what you need to do is then get company management. And I was speaking to one of our investments yesterday about exactly this. It's aligning management incentives with the company in ESG improvement so that they get basically remunerated for ESG scores, not just profitability, but ESG scores improving as well. And that's very important. So net improving in all areas, still probably slightly more in the front of investors' minds in Europe, but catching up fast elsewhere.
Okay, thank you, Mark. I have a question maybe for Jim on the US market as well, because you've already touched on it a little bit that the US is catching up. So I'm wondering, after Biden, might there be a drive for certain industries or certain companies? What will those be, in your opinion?
I think there certainly will be companies that are favored and others that aren't. That said, our approach always has been to buy or find the best house in the best neighborhood. And a certain political change for a period of time normally isn't enough to get us to jump into something, particularly if it's not a great business or a great company. And the political situation in the US has become so divided. And I think we're in the worst of all worlds right now in terms of a tick-tock pattern. And we swing far to one side, next administration swings us way back to the other side, the next administration swings us all the way back. There's an inability to plan for companies. So we're not really jumping too headfirst into what President Biden is wanting to do. That said, a company like Aptiv is a huge beneficiary in our portfolio. Aptiv is a company that produces parts for automobiles around the world. And when you think about a regular internal combustion engine, Aptiv has about $500 of content in each car. In an electric or a hybrid vehicle, they have about $1,100 or $1,200. So more than double the content per car. So if we really go to all electric vehicles over the next 10 years, without Aptiv having any content wins, their revenue pie could double in that scenario. So those are some of the, we think that's a great business, whether Biden pushes it or not, because the market's going to force that. But if President Biden gives it a little bit more of a shove, all the better for a company like Aptiv. So we will make sure that we have a couple of names like that in the portfolio that will benefit, but we're not going all in because, as we all know, politics is pretty darn messy, and some weird things can happen as you're trying to get to the finish line, and I'm not sure that the $2+ trillion stimulus bill will actually come to pass. I think it will be more like 750, 800 at the end of the day. Still a big number, but not as big as the headline.
So thank you very much, Jim and Mark, for answering your questions about ESG. The next theme I would like to move on is COVID. We have spoken that the companies you have in your portfolios have a more robust earnings pattern, a more robust earnings growth than the overall market. So I'm wondering, did you have any companies in your portfolio where COVID was a significant positive or negative driver? And how did you react to these short-term market reactions as the pandemic unfolded?
Let me start with the US portfolio and then we'll jump into the global portfolio. The market looked at this very, very simplistically last year. Stay at home, work from home stocks, good. Return to normal stocks, bad. And then we got to August or September and that flip-flopped. And then it was the recovery stories became good. The worst thing you could have done is piled into the stay at home or the work from home stocks in in May or June or July, because that trade was sort of done by then. And again, I think that's way too simplistic of a way to look at it, but that's how the market looked at it. That said, we're looking at it completely differently, which is as we go into this new return to normal environment, there are going to be huge behavioral changes. When you've done anything in your life for the last 15 months, the patterns become somewhat ingrained. So quite frankly, the work from home dynamic, and AllianceBernstein is laying out our plans, and right now it's 4 days in the office and 1 day from home, and maybe ultimately it becomes 3 days in the office and 2 days from home. Well, guess what? All that sort of office space in New York City or all that London office space, I think is going to be challenged over time. Or business travel, there'll be less business travel going forward. So hotels at the city centers, I think, are going to be challenged for a long period of time. So we're looking at those behavioral changes. Where do we see a benefit? We see a huge benefit in our portfolio in MasterCard. People are using their credit and debit cards way more than cash, and cash is slowly draining from society, and we're all using electronic forms of payment. You look at Nike. Nike is an example where the consumer couldn't go to the store and buy their pair of sneakers. They had to go online, and since Nikes aren't sold on Amazon.com, you had to go to Nike.com to get them. And so a huge shift to direct to consumer, which is a really nice profit shift. CDW is a reseller of technology products. Every company locked down, and you needed a digital presence to have your business capable of surviving. Everybody put it together as best they could last year. This year, they're going back and saying, how do we upgrade all our systems, whether it's work from home systems or whether it's digital or whether it's our cloud. So those are but 3 examples of the US portfolio. And that whole example of changing behavior is very important. And on the flip side, something like an Ulta Beauty, I think, is dramatically disadvantaged. It was in our portfolio last year. It's not in the portfolio now, because as people go online to shop online with Ulta Beauty, the margin on those sales is much less than when I go into the store and buy something in the store. So there's a permanent profit headwind to online sales versus in-store sales. And you also then have the brick and mortar retail that becomes a stranded asset to a degree, and that becomes far less profitable when you have fewer dollars running through the storefront. So absolutely, there was a knee-jerk reaction, but I think there are longer-term trends, and we've taken advantage of that in the US portfolio for sure, and Mark as well in the global portfolio.
Yes, you see very similar characteristics. I'm not going to go through all of them, but we had companies that were benefiting from actually doing COVID testing, like a Eurofins, which has done a fabulous job of providing tests within Europe. Abbott Labs in the US, similar. We've also got companies like Zoetis, which does basically drugs for pets. An awful lot of people have taken on pets throughout COVID. And as we all know, a pet is not just for COVID. They're going to have them for many, many years, and they need looking after. And it's one of the very strongest areas. We see the same within Nestle. Their pet food business is up double digits over the last year. So we've got some real winners. We've got some companies in the portfolio that were challenged as well, but they're going to be recovery stories as we move into the next 12 months. So something like a Disney, where the theme parks start opening up, you've just started to see that coming through. So we like a balance in the portfolio. And I think really going back to Jim's point, we're not trying to just focus on names that are one thing or the other. We're trying to identify companies that can grow consistently, going back to my original point, over time. And where we found ones which business model has changed, then we change our opinion. So we had one stock which was a contract catering business. Their business in for companies like our own in New York, we're never going to have that catering facility again because we probably don't have everyone back 5 days a week. So their business was changed through no fault of their own, and we just felt it was not going to be as good going forward, so we sold the position. But in the main, most of these businesses, they may have had a hiccup, but they're certainly still going to see very significant recovery opportunity going forward.
So thank you very much, Mark and Jim, for your insights on the COVID crisis. So to sum it up for the participant, there have been some short-term shifts and people have been driven into businesses, but there have also been long-term behavior pattern changes and even some patterns that have been there before, like digitalization, moving to online businesses that have grown more stronger and that will continue to benefit or to thrive after the crisis, while some businesses have taken a long-term hit, like it was mentioned before, like retail businesses with on-site stores. So it's really different, and it really depends on the long-term drivers for each company. So the next thing, or the last point I would like to touch on, is the outlook. So we have seen a lot of changes in the market since 2020, a crisis, very quick recovery, a sector rotation, and we are expecting a change in central bank policy, maybe with rising rates on the horizon, at least in the US. What do you think? How you think the economic reopening is going, and what are some of the investment implications? Also, would investors have to cope with high volatility, and how do you navigate it? So could you please speak about your views on that? So maybe Jim goes first for the US portfolio, and then Mark for the global.
Sure, I would put it into the category of never a dull moment. We are about to see the mother of all economic recoveries. This will be the greatest economic recovery Mark and I have seen in our careers. And as I said, Mark still has good hair. I have a whole lot of gray hair. But it's unlike anything that any of us have seen. And just to put a couple of charts here, you look at the vaccination rate. This was as of March 31st. We're now up to 50% of the US adult population is vaccinated. We are pretty darn close to herd immunity. Cases are falling off sharply. They were under 20,000 earlier this week. We are about to enter the return to complete and total normal. I live in Connecticut. I work in New York. Both states have now removed the mask mandate as of yesterday. So again, getting back to normal. What is so abnormal about this recovery, though, is if you look at the savings rate. Every other recession we've had, the consumer comes out of the recession in worse shape than she went into it. This time, the consumer saved a ton of money. So 20% savings rate, given all the government money that was stimulus money that was thrown at the consumer. That money has not been spent. It's been put into bank accounts. It's been put into Schwab trading accounts, and people are buying Bitcoin and all that kind of fun stuff. But that money is going to be spent on stuff and experiences over the next few months. I liken it to the roaring 20s after the Spanish flu. In terms of the job picture, we haven't gotten all the jobs back, but it's recovering nicely. And in the US, we have more than 8 million job openings. Quite frankly, with our unemployment scheme, people are incented to not work unless you can get a job more than $15 an hour. That runs out as of September. And I think that'll really push the jobs numbers up. In terms of US GDP, our in-house economist is looking at 6.5% growth. I think it's going to be higher than that number. And importantly, next year is going to be another good year. So you want to be exposed to companies that can grow quickly, but you also said, what are some of the repercussions? And one of the major repercussions is inflation. And let me just talk about that 1 second, and then I'll throw it to Mark. Inflation by itself is not a bad thing. And you see from this chart, these are the equity returns during past bouts of inflation. Inflation can be a very good thing because it generally signifies a good economic environment. But what we're really worried about this time is cost inputs, whether it's labor, whether it's transportation, whether it's metals and commodities and so forth. They've all gone up significantly, and there is going to be a profit squeeze. Those companies that can navigate that profit squeeze, that have pricing power, again, it gets back to what kind of company do you own? Is it a quality company? Do they have pricing power? Can you find those kind of companies in a concentrated portfolio? I think we can. If you can navigate that well, you're going to have the right to do well in 2021 and 2022. When we're seeing earnings from the first quarter, those companies that are seeing a margin squeeze are getting absolutely decimated in the equity market. So that's what we're looking at, and that's the most critical factor in 2021 for us. Mark?
So from my perspective, the market obviously went up a great deal last year, which was a surprise to a great many investors, given we were in a pandemic and we were seeing such a serious recession. And you can see here what happened really. In the first part of this chart, the market responded to a very, very significant sell-off in the first quarter because governments took the right actions and central banks took the right actions, providing enough monetary liquidity to secure market access and providing enough fiscal stimulus to make, as Jim said, it very clear that we were not going to see a recession that led basically to a very, very serious crash in economic activity, and that consumers were going to be able to save throughout that period. So we got through to about August, we were back to the original highs. Then we moved sideways until we got evidence that we saw the vaccines were working, and then the markets moved again. But what we had in that period, on the left-hand side, in the early period, you can see the technology area and the consumer discretionary, particularly the online retailers, did very well. In the second half of the year, the market moved very much more to things like energies and financials. And this is entirely realistic in terms of what's going on in the marketplace. We are moving to a recovery. It's like a normal recession in the sense of how the market is operating. It's just happening very, very quickly. But from our perspective, where are we now? And you can see there was a real bifurcation over the last few months between growth and value. Growth has had a good run for a number of years, but certainly over this year, you've seen a very significant outperformance of value from growth. And we don't think that's particularly surprising because of what's happening with regard to earnings and how that's breaking down. And you can see on this chart, it is very, very clear the difference. On the left-hand side, you can see earnings in 2020. On the right-hand side, expectations for earnings in 2021. Growth is in blue, value is in green. You can see what happened, particularly on the value side of the equation, in the second quarter of last year. Very significant fall off because these value companies, particularly if you think like oil companies, they were in a recession. The oil price, if you remember, went very briefly below zero for about a week. It was a very difficult time. Banks were in terrible shape. We understand why. On the growth side, you can see consistent underlying earnings growth. Now, run that forward to this year. That's all changed. And in particular, the quarter we are now in is going to see a dramatic outperformance of value relative to growth. Because those growth earnings held up, they're not coming from depressed levels. So the rate of growth in value is going to be very significant. But that is then going to tail off. And as we go towards the year end, you're going to see a picture where it's not going to be very different depending on whether you're coming out of the growth or the value side of the equation. And so coming back to what I was talking about and Jim was talking about, having a portfolio where each of the stocks has their own drivers of growth, we think is going to be much more important. And particularly when you run through to 2022, as the stimulus packages in the US, in Europe, in Asia, start to roll over, as financial conditions potentially start to tighten, I'll come on to inflation in a second, you are going to see growth rates move back to where they were in the pre-pandemic period. And if you remember, growth was not that great. And as we're all very aware, government debt is now very, very high. So maybe there's not quite so much firepower to keep pushing that debt up. So from our perspective, we think moving into the second half of this year and into next year, investors need to be very focused on what it is that the companies they're investing in do, why they're going to continue to grow, and why in particular, if we do see some inflation, we think there will be, we're seeing it. We don't think it's going to be so persistent, but it's probably not going to drop away. So if you see prices go up this year, they next year will not go up by the same amount, but they probably don't go back down. So what your companies need to be doing is being able to have their own pricing power to pass through that inflation and maintain their margins. So for us, it's really not about picking sectors. It's about picking great companies that can operate in an environment that's probably a little bit more inflationary, but not dramatically so.
So thank you very much, Mark. And I also want to send out a reminder to the audience that you still have the possibility to raise questions, as we have a few minutes left. And I also have one, which is about the Fed, because when we look at the current scenario, and we were all surprised, at least people like me were surprised to see like inflation over 4% in the US, even if it's just a short-term number at the moment. But I was really surprised because I don't know these numbers anymore. And also the high savings rate, which might implicate a massive consumption rally over the next months. So the question is about the Fed. What do you expect, Jim, from the Fed? Would you expect some tightening, and to what extent?
Sure. I'll say first off, the Fed has done a masterful job here. And obviously, President Trump put a lot of pressure on Chairman Powell, but he responded and he got us through, and certainly the monetary and the fiscal side, but he got us through as he needed to and took rates to zero. He also reassured the market that we're not even thinking about raising rates. Well, guess what? The Fed meeting notes yesterday said we're starting to think about raising rates. So they are at the point where, okay, maybe now it's time to tighten a little bit. What will that look like? Obviously, reducing the bond buying is the first step, and then raising rates is the second step. Do we have a rate increase sometime in 2022? Maybe in the back half of the year. I think Chairman Powell is very much like former Chairman Yellen, where you just don't want to screw it up and you don't want to move too easily. So unless the market forces the chairman and forces the Fed's hand, I think they're going to be slow here. And unless it gets out of control and they lose the narrative, I think that's a very supportive environment for equities. The one thing that has done, though, and it certainly is scary, and more so a couple of months ago, it has created bubbles in a whole variety of markets. And whether that is meme stocks, whether that is some of the tech companies trading at 20 times sales with no profitability, whether that is just the level of retail trading, whether that is SPACs, which we had more SPACs in the first quarter than ever before, whether it's Bitcoin, all of these are bubbles that are inflated by too much capital chasing too few opportunities. The great news from my perspective is the air is being let out of each of these bubbles very slowly. So SPAC issuance started to dry up in April and nothing's happening now. That's a wonderful thing. Retail trading activity, if I use Schwab as an example, in the fourth quarter of last year, Schwab did 8.2 million trades a day. At points in January and February, they were doing 12 million trades a day. That's now down to 6 million, so half the peak. That's a great thing. Bitcoin going from 60 to 40, and as we speak, it may be back up to 50, who knows? But that price coming down, again, is a good thing. And you want to take the speculation out of the market such that it all doesn't hit the wall at one time and then cause a lot of collateral damage. So from my perspective, the Fed's done a good job. I'm willing to give them the benefit of the doubt that they can continue to do so. But more encouraging is the fact that some of these bubbles and the pockets of froth are starting to go away. And we're also seeing that in the prices of the highest flyers in the market, many of which are down 20, 30, 40% on really no news. But I think that's a healthy dynamic. So I'm happy with what I'm seeing.
Okay, thank you, Jim. Also a question for Mark. Mark, do you also see globally outside the US some areas where you see some bubbles, like, for example, Chinese equities, China A shares had like a really strong rally last year. Is this something where you would be cautious, or are there other areas where you think they might be a bit fuzzy?
I think the point Jim makes is the most important. There is a lot of free money around the world, and it tends to flow to certain areas. and it inflates valuations. I think there have been certain areas within the Chinese stock market that probably has gone up more than you would expect, but actually the Chinese economy is growing very well. So when we look at our Chinese investments in the main, their earnings were very robust last year, and where they've gone up, their valuation relative to where it was before is very similar. So we're not too concerned about that. We do keep an eye on it, but the Chinese authorities have also been quite good at trying to manage the expectations of investors in that regard, and also take a little bit of speculation out of the market. So I think that's healthy. What we don't see in the same way as we're seeing in the US is the idea of interest rates going up very much. No one is looking at European central banks and thinking they're going to be tightening anytime soon. I think obviously very close to home, one of the interesting things will be the German elections in September. And if you do get a change of government, whether potentially you get a change in the rules of allowing more debt and allowing fiscal expenditure to go up in Germany, that would be a significant change to the marketplace. I'm not sure it does a wonder for German bonds, but I think so from an equity market perspective, it's probably fine. At the end of the day, if you're looking at an inflationary environment, the thing that matters is what levels of inflation and how quickly we see the moves. And levels of inflation are still pretty low, and bond yields are still very, very low. So moving up a little bit because of better growth is not a bad thing. And the second thing is just don't move too fast. If you do it incrementally, Jim's point, let the air out of the tire slowly. It's hard to do, but if they manage that, then I think we'll be fine. What we don't want is dramatically rising inflation and dramatically moving interest rates that unsettle investors.
Okay, thank you both, Mark and Jim, for sharing your insights today. It was really interesting to hear also about the different markets, because there are differences between the US, between Europe, between Asia. So thank you all for answering our questions. What I have taken away for the current environment, that it's still a pretty good environment for stocks, but you have to be selective and also look for the pricing power of the companies, because when you look at inflation rates and maybe the central banks not acting too strict or too hawkish at the moment, while rate rises in the US are possible, but not too extreme, and still could have companies that can cope with inflation, that can forward higher prices to their clients, which might be the sweet spots, and also maybe company that benefit from the long-term trends the pandemic has driven us. So I think also we don't have any more questions from the audience. So I want to thank you also. I want to also thank the audience for being here today, for listening throughout our webinars. And at the end, I would like to point out that you can also access our past webinars, also this webinars, for the replay on our free website, www.scopexplorer.com, where you also find research about our fund ratings, peer group analysis, and asset manager ratings. So thank you very much all, and hope to see you soon at one of our next Scope webinars, and have a good day.
Thank you very much.
Thank you.
Bye.
Bye.
Thank you, everybody. Bye-bye.